Hey, welcome everyone. I'm Ted Erhart. We've spent a lot of time talking about tax strategies over the last month. This has led to some great dialogue with clients. Now, most of our clients are baby boomers, which means we frequently see situations where they're helping out aging parents with their own finances. If you have elderly parents with modest incomes and specifically some relatively small retirement accounts, there's probably a good opportunity for some basic tax strategy. That's what we're talking about today. Let's get started. Before we jump in, if you like the content, please do me a favor and hit the thumbs up button if you're watching on YouTube. And feel free to drop me a comment if you have any questions. I always try to respond, and this also helps me gauge whether or not my message is being articulated clearly. So again, oftentimes we'll see our clients helping their aging parents manage their money. Frequently, I'll see situations where the parents, are well into their 80s, they've slowed down, and they're basically just living off Social Security, so their income is very low. And they may have some retirement savings, but they're basically just planning to pass those on to their kids. They have no intention of spending the dollars. So let's take a look at a quick example. Let's assume Warren and Susie, they're each 85 years old. Their income consists of about $30,000 of Social Security benefits, plus a small required minimum distribution from Warren's IRA. Now remember, most retirement accounts are comprised of pre-tax dollars, which means they're taxable upon withdrawal. But in Warren and Susie's case, their income is low enough so they're not paying any income tax on these relatively modest withdrawals. In other words, their federal tax rate is zero, and this is largely due to the standard deduction. Now, if you do the math, which I've done, Warren and Susie could actually withdraw upwards of $20,000 from this IRA and still pay no federal income tax. And herein lies an opportunity for both some tax and estate planning. Again, at this point in their lives, we're assuming Warren and Susie have no plans to spend down Warren's IRA beyond what he's required to take out on an annual basis. Again, basically this plan is the money's going to their kids. Now here's the key thing to remember. Were Warren and Susie to die today, their kids would inherit this retirement account, but because it's made up of pre-tax dollars presently, the kids would ultimately have to pay the income tax, potentially at a much higher rate. So where I'm going with this is Warren and Susie, because their income is very modest, they could start taking larger withdrawals from their retirement account now in an effort to get as much money out at a 0% tax rate as possible. What they could do over time as they pull dollars out at 0% is they could just reinvest in a non-retirement account. And the benefit ultimately is upon their passing, when the kids inherit the dollars, they're basically, I'm kind of oversimplifying here, but they're generally going to inherit those tax-free. So if their kids inherit them and they want to start spending those dollars immediately for their own retirement or whatever, there's going to be no income taxes due. That contrasts to a retirement account. If their kids actually inherited Warren's IRA, which were all pre-tax dollars, they would be 100% taxable at whatever the children's tax rate is. So by getting the dollars out at 0% before Warren and Susie pass, it's kind of a win-win for everyone. Now, the most important caveat to this entire strategy, this discussion here today, is understanding how increased income affects the taxation of Social Security. So put simply, as income goes up, more of one's Social Security benefits becomes taxable. And you can see the key thresholds in this table. Long story short, I don't want to spend a ton of time on the taxation of Social Security because it's complicated, but make sure you work with a tax professional to avoid any tax traps. And again, especially if your objective is to try to capture or try to pull as much money out of a retirement account at 0% as possible. So if you have aging parents with modest income and some retirement accounts they never plan to spend, there could be an opportunity to get some or all pre-tax dollars out of those retirement accounts at a 0% tax rate. It ends up being a win-win for everyone. So look, as always, appreciate you tuning in. I hope you consider subscribing to the YouTube channel if you haven't already, and we'll see you on the next one.